Good afternoon. My name is Thomas Senek. I'm the founding partner of TM Wealth Management, and we're excited to be with you on this webinar today. We're going to talk about an investing playbook for the new administration. We'll give everybody just a couple more minutes so they can get into the webinar here. I'll give you just a brief overview of who we are and the services we provide at TM Wealth Management, and then get into some specifics about what we're expecting and looking for in 2025 with a new incoming administration and how we might want to position our portfolios as we look towards some of the changes that might come with the new administration. So just give it another couple of seconds, give people a chance to get logged in and be a part of the webinar here today. We won't have time here at the end of the webinar for any questions. We usually try to keep these pretty tight, be respectful of everybody's time. But if you have specific questions, you can either put those in the chat, shoot us an email afterwards. I think after the webinar, there'll be an opportunity to fill out a quick survey, and we can get the information and get your questions answered, reach out to you directly. Additionally, we have a number of resources that are available. So if you'd like any of the resources, if you'd like any copies of the slides or what we're presenting here today, just let us know and we'll get those copies out to you. Great. I think we're going to go ahead and get started. Just a initial overall disclaimer here that this information is designed to be educational. It's a presentation on some thoughts and ideas, but it's not to be construed as specific legal, tax, or even financial advice. It's designed to provide some education. If you want to get specifics, then we can sit down and talk to you about how these principles and ideas and this education might apply to you specifically. But we encourage you to meet with your professionals to see how this information might apply to your specific situation. Just a little bit about me. I started my career on Wall Street working for large investment banks, Goldman Sachs, Deutsche Bank on the investment banking side, doing large initial public offerings, IPOs, and M&A transactions. And as I went through that process, I learned a great deal, really enjoyed it, but found there were two important things that I learned about myself. The first is that investment banking is not conducive to a family, and that's really important to me. And then two, it was very transactional. You do a large transaction, everybody does good work, and then the next day you're on to something new, a different transaction. And so for me, I found that I needed to do something I felt that was more relationship-based and felt like I was having an impact on the people and causes that mattered. And so the ability for me to sit across from families and individuals and help them make good financial decisions so that they can have the lifestyle or fulfill their life's purpose, that's rewarding to me. And that's what we try and do here at TM Wealth Management. And a little bit about us and our firm here. The first thing is that we're independent. We don't have a home office or someone large corporate headquarters telling us, hey, we need to make sure we're focusing on these products or these strategies. We work specifically for our clients, and we're an independent registered investment advisor. Secondly, boutique was important, right? When I worked on Wall Street, worked for large investment banks, and that was great experience, and they do great work. But for me, I wanted to make sure that we could spend the time with the families and individuals to really understand them and what they were trying to accomplish. And so that we can become that trusted advisor on all things financial, not just investments, but everything that's going on in their financial lives. So the boutique nature that we have, we feel is a real advantage to deliver specific and customized financial advice. Also, wealth management. You get a lot of folks that are providing financial advice and they only focus on your portfolio. And while that's valuable, we understand that there's a number of other areas in your financial life that matter. Taxes, estate planning, insurance, education planning, all elements have an impact on your ability to make good financial decisions. We also don't only focus on things that we get paid on, right? We provide financial advice to our clients across the board on all elements that impact their financial advice, whether we get financial lives, whether we get paid on it or not. That's our role, is to be that trusted advisor. And then lastly is the regulatory structure under which we've chosen to register is the fiduciary standard. As a registered investment advisor, registered with the SEC, we are required to do what's in the best interest of our clients. And you might think, well, isn't that how everybody's registered? And the answer to that is no. Some people register under the suitability standard. Some people aren't even registered as financial advisors. They might be registered as insurance professionals, and they do great work, but they have a different regulatory structure that they have chosen, and it is not the fiduciary standard. So for us, we feel it's important that we select the highest standard of care, which is the fiduciary standard. Great. That's our short little commercial. Hopefully, you know a little bit more about us. If there's anything we can do to be helpful to you, please don't hesitate to reach out. So now on to the topics. A couple of themes that we want to talk about as we think about, Trump 2.0 or version 2. On the positive side, we expect there to be less regulation, tax cuts, less government spending, and a focus on business and growth. On the potentially challenging side or negative side, right, there's been talk about deportation, tariffs, inflation. It might impact unemployment. So we want to talk about some of these things and how we may want to look at those, but also how they might impact your portfolio. Interest rates is a second theme, right? So there's a impact that all of these policies might have on interest rates. And interest rates have a wide-ranging impact on the economy, all the way from mortgages up to credit card debt, up to the federal government's borrowing rate. So interest rates are an important element, and how some of these policies might impact interest rates is important. And we want to talk a little bit about that and how the Fed is viewing interest rates and potential cuts to interest rates over this next year as this new administration comes in. So as we look at that, this is the most recent outlook for the Federal Reserve and where we think interest rates might go. So you can see the gray line there is historical. This banded area that has a blue and yellow line, these are the projections, right? So the blue is what the Federal Reserve presents. At the end of their meeting, they say, hey, look, here's where we expect rates to go. And you can see that they're expecting rates to go down. Now, I will tell you, every time they share this graphic, they never follow what the expectations are. So it doesn't go based on their projections or what their expectations are. It goes on what they decide to do at each meeting that they have and the information that and the data that they receive prior to that meeting to make an informed decision. The yellow bar is what the market expects to happen. You can see the market is a little more less aggressive in the rate cuts that maybe the Federal Reserve is presenting. And so what we see over the next year, at least what the Federal Reserve has telegraphed, is they're going to be a little more patient about cutting rates. And so the expectation right now by the market is that the Federal Reserve might cut rates 2 more times in 2025, right? And usually they make a rate cut of about 25 basis points or 0.25%. So if two cuts over the next year, that's a 0.5% lower interest rates. And the reason that they've kind of pulled off a little bit of the number of cuts is the economy is doing well. They want to make sure that the economy isn't overheating. Unemployment is low, and we saw today that inflation is coming down. And so there's not a need for them to start to cut rates. I know a lot of us remember the days of 3% and even 2% mortgage rates, or 0% car rates. Those may be a thing of the past. And what we're at right now is a more normal kind of interest rate environment, right? Mortgage rates that are somewhere in the 6 to 7% range historically is a little bit, on the low end and somewhat normal. So maybe we're getting a little more normal kind of interest rate environment. The impact that some of the policies that new incoming administration might have could prove to be inflationary. And that's also another reason why the Federal Reserve is holding off on cutting rates any further. And one of the things that the incoming administration has talked about is, hey, we're going to do mass deportations. And the question that we've got to have as we look at this new administration, because we've been here before, right? This is Trump's second 4-year stint as president. And one thing we've learned is we've got to be cautious about reacting to what he says and being more focused on what actually gets done, what policies get implemented. So is this idea of a mass deportation Is that really going to be implemented, or is it more of a strategic deportation of folks that aren't contributing to the country and to our economy? But you can see here some of the areas that might have a significant impact. Construction, drivers and truck drivers and sales workers, cleaners. Those industries might have a more significant impact in terms of unemployment than maybe some others. And if we have a lower workforce or less people able to work, right, that's going to potentially increase the unemployment rate, or sorry, decrease the unemployment rate, which means there's less workers. And so if there's more demand for workers, but there's fewer workers, that means that companies are going to have to pay more to get workers to work for them. And that can be inflationary, because now as wages go up, things become more expensive because the cost to pay people to produce things goes up as well. So something to keep an eye on as the new administration comes in are we really going to see a lower unemployment rate, or are we going to see something a little more stabilized? The other element that he's talked about is tariffs, right? And this is just a graphic that different economists and think tanks have put together about what they think the policy is going to be and the overall impact. And one of the proposals has been, a 10% across the board tariff, and then significantly higher tariffs for China and Mexico. And the impact of those are significant to our real GDP, right? It could be anywhere from a significant, 1 to 2% of GDP, to a rather insignificant, single basis point, maybe 0.01% to 0.02%. But the key here is that there will be an impact and there will be tariffs. I think that's something that we can be for sure. The question is going to be, what is the impact going to be? And what we see is the tariff impact is going to be more kind of like Swiss cheese, right? There's going to be a tariff, but there's going to be carve-outs for different countries, different industries that we want to make sure are in the best interest, or the administration wants to make sure are in the best interest of the country in their view, right? So maybe a certain country gets no tariffs because they've been, providing intelligence to the United States, and another country is strategic for whatever reason, and they don't get a tariff. So we think there's going to be tariffs, but it's going to look kind of like Swiss cheese with a bunch of different carve-outs. The last theme that we want to kind of focus on here is valuation, right? And this graphic here just looks at the historical stock market value is about 17 times earnings, forward earnings. So that means that for every dollar of forward earnings, the value you're paying $17 for that future earning. And that's been kind of the 30-year average. You can see right now we are at about 21 times forward earnings. So we're beyond, significantly higher than where the 30-year average is. And so that gives us a little bit of pause in terms of how we may want to allocate and look for opportunities that might provide a little bit better valuation opportunity, rather than just blanket investing in broad-based sectors or industries. And so as we look at where those valuation opportunities present themselves, that's what we want to be focused on. Additionally, when we talk about stock valuations, one of the things that the incoming administration has talked about is a reduction in the corporate tax from 21% down to 15%. This graphic here just highlights which industries will benefit most from a reduction in the corporate tax rate. And you can see the consumer discretionary, companies like Amazon and Walmart, where we spend money when we have excess money, versus consumer staples, right? We spend money at grocery stores because whether the economy is doing well or not. Discretionary things like travel, Amazon, Walmart, where we go to buy things because we want them, not because we necessarily need them. You can see that a reduction in the tax rate would provide a almost 7% earnings per share increase in consumer discretionary. Communication services, a 5% increase. You can see that it will impact everybody positively, but certain sectors more significantly others, right? Financials. So as we start to look at the potential of significant corporate tax rate changes, it may make some sense to look at, hey, what's our allocation? What's our exposure to consumer discretionary, consumer services, and financials? The other thing when we talk about the valuations, there's an opportunity here because there's been a lot of money on the sidelines, a lot of cash on the sidelines waiting for kind of the all clear, waiting to see what the overall policy positions and impact of the new administration might be. And so as the clarity starts to come, we'll see a lot of that money, that cash come off the sidelines and come into the market. And the market, just like any other economic financial system, is based on supply and demand. And there's only so many stocks out there. And if there's more money chasing fewer stocks, then those prices will go up. And so that's another thing to keep an eye on, is that we see some of the cash coming off the sidelines as we start to get some clarity about what the specific policy implications might be. And then as we look at where those opportunities might be, this is a graphic that illustrates in certain market sectors, where are the valuations potentially, where are the opportunities, right? So if you look at, this is the 10-year annualized return on these different types of investment opportunities, right? So large growth companies versus small value, right? So the 10-year annualized return of large growth sectors is almost 17% per year. Year to date, which is just a short period of time, this is over the last 2 weeks, right? You can see growth is down 1.5%. Large value is up. Mid cap growth is up 1.2. And then what we look at over here on the far right-hand side is, what is their relative value in terms of, are they overvalued and undervalued? And you can see at the lower quadrant here where it shows what percentage of the S&P or of their 20-year PE. So anything, if this number was 100%, that they'd be right at their 10-year or 20-year PE average. Anything that would be below 100% would be undervalued based on their 20-year PE average. So you can see everything is over the 20-year price earnings value, except you see down here in the small value sector, they're pretty fairly valued, right? So maybe there's some opportunity. You can see that across the board in the value sector. And when you think about value, think like, your financials, your oil and gas, your Walmarts, versus the growth side over here, we'll see the Apples and Microsofts and Nvidias, right? You can see they have a significantly higher valuation metric. So as we look at the market being somewhat on the higher value side, there's certain sectors that are a little bit more fairly valued, or maybe want to allocate, maybe looking at some of the more value positions rather than just purely the growth. So as we think about this incoming administration, we've talked about some of the upsides, right? Lower regulation, more business focused, more growth focused, and more clarity on tax policy. We expect the corporate tax rate potentially to come down. We expect the current tax cuts to be extended. We don't think they'll become permanent, but we think they'll be extended for probably till 2030, for another 4 or 5 years. So that gives us some additional tax clarity as well. On the challenging side, deportations will be challenging. Tariffs will be challenging. These are all things that will increase potential inflation, which puts some pressure on the economy. So those are some things that we want to be aware of and be focused on. And so now we look at, okay, what do I do? Right? Well, some of the key things that we focus on with clients is we want to increase the exposure to alternative investments. These are things other than traditional stocks and bonds, things like real estate, private credit, private equity, natural resources, right? And so a couple of other things we've been looking at, private credit provides 9.4% yields, data center investments, direct real estate investments, private equity. Those are some opportunities. Real estate continues to provide inflation protection and income. And so looking at those, but being very specific, right, about where you want your real estate exposure. rather than residential or commercial, we want to focus, at least our recommendation is focusing on more infrastructure focused real estate holdings rather than the traditional residential or commercial. We want targeted fixed income exposure. So we want to be neutral on duration. We don't want to go too far out on the yield curve. We want to stay kind of short term to mid intermediate term to make sure that we're not too far out on the yield curve that can have some wild swings in fixed income as interest rates change. And then lastly, when we look at opportunities in equities, as we talked, the valuation of the Magnificent Seven, right? The seven securities that have significantly outperformed everyone else in the S&P 500. We think the other 493 companies are now going to start to catch up. And so small and mid cap and value become much more interesting from a valuation standpoint than maybe some of the other growth sectors that have some significant increase in valuation. So one of the key things to remember is to have a strategy, have a plan when you are investing, and that markets don't go straight up. Be prepared for there to be some significant ups and downs in the market because there's some significant uncertainty about what policies the new administration will implement and what will actually get passed through Congress that they can implement. And as those things start to have some clarity, now we can start to position portfolios. Be wary of headline risk or even what comes out of the administration from a vocal or headline perspective. And let's really focus on what actually gets done and what they can actually implement before we start to react negatively in our portfolios. And with that, we're here to be helpful to you and be a resource as you're trying to think about how to position your portfolio to achieve the outcomes that you want with your financial resource so that you can have the biggest impact on the people and causes you care about most. With that, we appreciate you joining us today. Hopefully you've got some information that now you can make better financial decisions. If you have specific questions that we can be helpful to you, please don't hesitate to put that in the chat or in the survey responses, and we will definitely make sure we respond to every question that we get so that you have the information that you need to make good financial decisions. Thanks for joining us and have a great rest of your day.